Hello, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles. And this is Trading Market Cycles, where we look at cycles and try to help understand markets and make real decisions about what to do with our money, incorporating cycles into our decision-making process. So got a lot of interesting stuff to cover today. Going to take a look at the big picture. We got some new CPI data out today. You know, I've been following inflation for a while, and then continuing to really look at how the pieces of the puzzle could fit together into some actual portfolio decisions, because, you know, investing is about more than just being stimulated by infotainment for our entire lives. It's about actually making real decisions, asset allocation, for our wealth. So let's get into it. Going to cover, starting with the big picture. Got some interesting insights that I've been working on together with ChatGPT. Going to show you that. And then we'll wrap up with taking your ideas. If you've got ideas that you want me to explore and look at, please do put them into the chat and I will get to them. First come, first serve. So get them in there. And otherwise, we'll get to those covering ideas specifically after about 15 minutes of a macro view on the markets. So let me share my screen here. And we'll get going. Just one sec. All right, so starting out, today is CPI day here in the United States, where we got the July CPI data. And for those of you who have been watching for a while, you know that we've been following the 5.5-year cycle in inflation and unemployment, CPI in particular. And we know that CPI is bottoming right now and likely turning up. So the headline that we got this morning was inflation held steady at 2.7% in July. So everybody should be breathing a sigh of relief, right? But prices excluding food and energy, so-called core inflation, rose 3.1% over the past 12 months above forecasts. So we can see here, this is just a Wall Street Journal article, right? We can see inflation ticking up just a little bit here in overall and in core. And that should not surprise us, since we've been following for a while this 64-month cycle in inflation and CPI. Big spike on the chart, as Lars would say. It would hurt if you sat on it. And we've got we've got momentum picking up here along the bottom in the cyclic RSI. And of course, we've got this 64-month cycle bottoming. And this has been a very good cycle, right? At the bottom, top, bottom, top, bottom. Ouch. That was a big one. And here we are in the cycle bottom again. So we've been expecting for a while inflation to gradually creep up. And, you know, these hold steady prints that we've been getting. Again, inflation held steady at 2.7%. So markets are rallying today, expecting maybe the Fed will cut rates. I'm still not a buyer of that hypothesis. So my forecast and the cycle's forecast is that inflation should tick higher over the next 6 to 12 months. We also have been tracking unemployment, in particular, the 67-month cycle in unemployment, having bottomed, rising. We got the revisions in the job numbers last week. And of course, these numbers are volatile, absolutely. But the trend of slowly but slightly rising unemployment has been unfolding for a while, and certainly is what the cycles are anticipating as well. So that's the backdrop that is still primarily in mind for the macro picture over the next little bit. We've been tracking the geomagnetic data in that cycle. It's about, a quarter up, a quarter down. And we did get a pretty good turn up in the geomagnetic activity over the past week. So that's interesting. The cycle had been predicting it a bit earlier, hadn't shown up yet. And then now it's starting to turn up. Suggestive that there may be a little more psychological tension in the markets. We'll see. But I certainly wouldn't be surprised to see it show up in the next few weeks. In terms of cycles in equities, right, we've been looking for a top for a while. We've been noting the negative momentum divergence. So we don't have a new high in momentum, even though we have a new high in price, right? And we see that cycles are not supportive of a lot higher prices from here. Meanwhile, we haven't gotten a significant break in prices, but definitely cautious on equities, particularly the S&P 500 here. Picture looks similar in the NASDAQ. Momentum top back here in 2024. Another one here. We still haven't gotten above even that level of momentum, right? And here we are today with the cycles, again, signaling caution. Here's the Russell 2000. Haven't made new highs in the Russell 2000 even since 2024. And probably further back than that. And again, same kind of negative momentum divergence into cycles. Caution. So yes, equities have been going up. They haven't started going down yet, but they're not going up a lot. And again, I'm cautious on equities and have been for a while. This is the US dollar. We've been following this one for a little while. Cycles and momentum suggestive of the dollar going up. Bitcoin looks a lot like equities. Cycles tapering off. Negative momentum divergence. Gold. Also, momentum declining, price just flatlining, cycle suggesting decline. And then looking at treasuries, 2-year treasuries, cycle suggesting decline. Same with 5-year treasuries and 10-year treasuries. But we see in longer term treasuries, the 20-year, the TLT, and in the 30-year futures treasury bonds, we see the cycles and momentum suggesting potentially higher prices ahead. I'm going to wrap all this up here in a macro thesis in just a moment, so stick with me. Commodities, DBA, the agricultural commodities here, the cycles are suggesting up. Energy, cycles are suggesting up. In particular, there's an interesting setup in natural gas this week with potential cycle bottom and positive momentum divergence. And so that picture, say over the next few months, we've got inflation potentially creeping up along with unemployment, right? We've got equities and Bitcoin risk assets topping with negative momentum divergence. We've got gold looking toppy And then we've got short-term rates looking like they might go up and long-term rates looking like they might go down, along with energy and agricultural commodities suggesting a little bit of potential upside. So I took all that and I put it into ChatGPT and I said, let's talk about what these different suggestions from the cycles work together could say about what the market might do over the next few months. Okay, so our cycles outlook, equities and crypto, risk of topping within 6 months, likely declining in the near term. Inflation and unemployment both set to rise, a stagflation light dynamic. I agree with that. Treasuries, short and intermediate term, prices falling, yields rising. Long-term, prices rising, yields falling. Gold falling, the dollar rising, commodities and energy rising likely from supply side shocks or tariffs. That is the picture that the cycles are suggesting. Okay. We've had Michael Howell on our show before of Capital Wars. Lars has interviewed him a couple of times. And Michael Howell talks about the liquidity phase and that markets right now are mostly about refinancing and not about real economic growth. It's how do we manage debt and how do we make sure that our capital flows and our balance sheets are going to support the maintenance of that debt, right? I find that to be a very compelling narrative and hypothesis explanation of what's going on in markets right now, particularly when we look at the longer term cycles in interest rates, which likely are heading higher for the next decade or two. So according to Michael Howell, we're currently in phase 2 of the liquidity cycle with liquidity peaking and now contracting, right? Liquidity contracting isn't good for risk assets like equities and crypto. Conditions are driven by fiscal dominance. Large government borrowing needs pulling liquidity from the private sector, right? The government needs liquidity, needs to be buying the treasuries and helping to refinance the debt. Public sector funding priorities crowd out risk assets. So central bank liquidity, Fed keeps short rates high due to sticky core CPI, right? This is what could explain potentially, risk assets like equities and crypto having less liquidity if the Fed doesn't lower rates. Commercial banks, tight lending standards and deposit outflows to money markets drain credit from private sector. Again, risk assets weaken. Tariffs, geopolitical risk, and cost push inflation trigger US dollar demand. And foreign capital flows into long duration treasuries, the safe haven trade could be a possible explanation for that. So, possible 2-month fundamental trigger path, commodity energy spike from supply disruptions or geopolitics. Putin and Trump have a meeting here. Ukraine is on the radar. I don't think Iran and Israel have settled everything yet. I think that's definitely a possibility. CPI, PPI print hotter than expected. Fed repricing hawkish. Okay, so far, the headline again today was inflation held steady, but we know that core is creeping up more than headline. So I'm not convinced that we're going to see rate cuts in September. Equities and crypto sell-off on growth and earnings fears. I think that's a possibility. If we do have a tightening liquidity cycle, then that liquidity is drain from the markets is going to be a headwind for equities and crypto. And of course, we've got that big momentum divergence in equities and crypto too. Short intermediate treasuries fall, long duration rallies on growth concerns. US dollar strengthens, gold falls on higher real yield. So this is probably the shakiest part of my thesis, with the dollar strengthening and gold falling. But if we do see higher real yields, then those are plausible paths for the dollar and gold. So that is my big picture macro analysis of what we might expect for the next few months and what narratives in the markets could support these moves. So that's the macro picture. I'm going to stop here for just a minute and pop over and see what's on your mind here. Hello, everybody. Thanks. Great to hear from you. Thanks for showing up today. So I hope this is making sense. And I did want to make sure you have a good understanding of what the cycles are saying and how the pieces of that puzzle fit together, right? So if we have equities and crypto and risk assets, coming into a bit of a liquidity crisis, I think we still have some geopolitical risk. And I wouldn't be surprised to see short-term rates not fall, maybe even rise a little bit, but longer-term rates fall from a kind of safe haven knee-jerk reaction over the next few months. So that's my overall thesis about, it's my macro picture of the markets put together, from cycles, but also from my own reasoning about the markets. All right. So now let's go back. And in particular, we've been working on putting together a portfolio of ideas that align with our investment hypothesis and that also have support from cycles. So currently in the portfolio, we've got Berkshire Hathaway, DBA, the commodities, ETF, agricultural. O is a realty investment trust, real estate investment trust. TLT is the longer term treasuries. UUP is the US dollar. XBI is biotech. So biotech doesn't really align with our hypothesis here about risk off. So kind of question mark there, but the cycles are pretty compelling on biotech. And then XLP, which is consumer staples, which is kind of a defensive play, right? All right, so just wanted to take a quick look at the XBI biotech cycles. We looked at these last week and we added this to the portfolio last week. So we have very positive momentum divergence here going into a pretty compelling cycle bottom with the 157 and the 296. We could add a little more data here just to see if the cycles hold up. Although this is weekly data. Yeah, it does go back a little further. So that one really jumps out. 166 and then this 333. Not as clear on the spectrum, but is pretty much 2 times the 166, right? Almost a perfect 1-2 harmonic. So pretty interested in that. So the cycle's bottoming nicely and nice support from momentum as well. So I still like XBI from a cycle perspective, even though it doesn't completely align with the current investment hypothesis. So gonna hold on to it, but keep an eye on it. So did some scans this week, in particular with our new watch list cycles scoring. Okay, we've been following this and using this over the past couple of weeks and wanted to show you a couple of opportunities that popped up from our scans this week. One is PepsiCo. And Pepsi has a good cycle here at 120 and also at 165 here. In particular, though, Pepsi has a cyclic RSI buy trigger coming up off of a low into a cyclic RSI buy trigger with support from the cycles. Meanwhile, I'm not crazy about the new lows in momentum over here. I would love to see a positive momentum divergence, but I like the cyclic RSI buy trigger here, and I'm interested in the positive cycles going out into mid-2026. And then another one that popped up on the radar is IQVIA, IQVIA. Similar to Pepsi, right? Yes, we had this new low in momentum, but we have a cyclic RSI buy now and strong cycles into 2026 and 2027. So we're going to take a look at both of these and see how they might fit into our portfolio. I'm not sure if we have them currently in our collections yet. So let's see here. Yeah, okay. So we're going to add Pepsi. And IQV. Yep. All right, now we're going to go back to our portfolio of cycle trades. Pull up our collection of candidate buying opportunities. Sort by correlation. Pepsi has about a 51% correlation to our current portfolio, and IQV, what happened to IQV? Don't see that it made it into the collection. Let's try that one more time. Yeah, I didn't click it quite right. All right, not sure why that ticker is having a little trouble. Try bulk entry. All right, there we go. So back to our portfolio. All right, Pepsi and IQV both have about a 51% correlation to the current portfolio. That's not ideal. I'd like it to be lower, but sometimes you got to work with what you got. So it's not a super high correlation. So out of these two, I kind of like, let me just look one more time. IQVIA has, I think, a little stronger cycles. Pepsi, not as bad, not as hard of a momentum hit. So let's try adding IQV to the portfolio. All right. All right, so when we add IQV to the portfolio, we lose a little bit of exposure and diversification, but not much. And where'd it go? Down here. Yeah, no. We got to lower the position size a little bit to about, let's say, 7 shares. Get it in line with the other positions. Okay. All right, so Now we've got exposure around $285. That's in line with our other positions. Correlation is pretty high though at 63%. So I'm not really excited, not really feeling this one yet. Doesn't quite do anything for my portfolio, yet brings some extra risk to the portfolio. So I'm not gonna put it in the portfolio. All right. So come on back. Just summarizing what I've done here. So I've used cycles to understand which way is the wind blowing in some core asset classes like equities, rates across the spectrum, Bitcoin, gold, the dollar. Through that, I've worked with these remarkable new tools like ChatGPT to say, hey, this looks to me like which way the wind is blowing in these different asset classes, commodities, energy as well. You know, what kind of scenario, if these were to unfold, what kind of world would we be living in? And it helped me formulate a macro picture that aligned nicely with another market analyst who I respect a lot, Michael Howell of Capital Wars. And the big thesis being that we are in the late stages of a liquidity cycle, which probably has peaked, with liquidity likely declining, which would be bad for risk assets. And if we did have some kind of supply shock or unexpected tariff impact, we could absolutely get a flight to safety into the dollar and long-dated treasuries. So that is my macro hypothesis. We all have to be in the markets with a point of view. There's no escaping that. Some famous general said, planning is everything and plans are nothing, right? So we do have to have a point of view to be in the markets. We have to be able to respond to market conditions as they arise, right? And then we have to be able to ultimately make real decisions for our portfolios and use good risk management in the process. So that is what I have put together for you, what I have to share with you for today. Happy to take a look at anything that you would like me to take a look at. If we go back just briefly to our scorecard watch list, we can see other ideas that are popping up. Excuse me. Berkshire still showing a nice buy signal. I like that. Other hots, Intel. So that's an interesting one, right? Intel's been in the news lately. Had a nice move up, and wow, that's some serious cycle support with very nice positive momentum divergence on Intel, which has been very beaten down. So that's pretty interesting. We could also look at the weekly data on Intel. Also have positive momentum divergence. Some pretty nice cycles, especially this 101. Not all of them are on the stable side. I like it. Well, Intel looks very interesting to me. Going to pop back over to RiskSmith. Add it to my collection here. Go back to my portfolio and see if I might consider adding Intel to the portfolio. So what do we got? 40% correlation. That's pretty good, actually. And Let's try turning it on. We've been having to do about half this size. So let's say go with 50 shares. All right, so Intel, we added $269 of exposure to Intel. It's about a $1,000 position. And it only cost us $106 of exposure. Increased our discount a little bit. Didn't hurt our diversification. This portfolio has excellent diversification. So I like it. We found a stock to add to the portfolio this week. Approved. So we now have 8 positions in the portfolio that we've put together over the past few weeks. And it's got excellent diversification in this portfolio, increasing right now as well. Good exposure, discount, and reasonable risk. So I like it. All right. Let's pull this back over here. Progressive, WTKWY. I'm not sure which one that is. Hi, smiles are good. Mark. Let's see. What is the determining factor on percentage of risk using the cycle finder? I'm not sure. The question mark. If you want to make a little, get a little clearer, that would help. Walter's Kluwer. Okay, WTKWY. And the watch list is not part of the basic subscription right now. It's part of the pro subscription. So thanks for the question. And the Progressive Corporation. All right, let's take a quick look at those, see if we can find another good idea for the portfolio. So we're going to jump back over here. Start with Progressive. Ooh, look at that cycle, man. They don't get a lot clearer than that. It's an excellent cycle. Momentum is bottoming, but hasn't really turned up yet and given a buy trigger, but it looks pretty interesting. We had the 62. Yeah, that looks interesting. Let's take a look at the weekly data. Messy spectrum, nothing really sticking out clearly. So nothing that's really adding to my confidence there. But I think going back to just the daily data, that looks pretty interesting. Candidate, I'd say. Not a lock, but a candidate. So one more was Walter's Kluwer, which was WTKWY. Let's see if that one shows up. Ooh. I mean, ouch. The price is declining rapidly, momentum hitting new lows. Cycles are a little muddy, especially longer out in the spectrum. So nothing really jumping out at me here, but the cycles are pretty strong. But that's a falling knife right there. So, I mean, you could say it's past a cycle bottom. So maybe there's hope of this fall being arrested, but I'm not a buyer when price and momentum are making new lows. Progressive though, that one looks worth adding to my watch list. So just going to go back over here, pop in PGR. So keep it on the watch list, and might take a quick look at how PGR relates to the portfolio in terms of correlation. So let me add that collection back in of candidate ideas. PGR, yeah, it's 48%. Again, not great, but interesting. So I'm not a buyer of progressive here yet, but I'm glad it's on my watch list, and I'll be keeping an eye on it going forward. All right, everybody. Appreciate you tuning in today. Again, macro-wise, I'm not a buyer of equities here, although, I am long some equities in longer-term positions, and I'm not selling. Okay. Haven't seen a big trend change yet, but I'm not backing up the truck. I think we are likely in the late stages of the liquidity cycle. I think liquidity is likely to be draining. I think that's going to be headwinds for risk assets. I think that inflation and unemployment are likely to rise over the next 6 months. I think we're already seeing signs of that. So I don't think we're going to be getting Fed rate cuts. If we do, I'll be fading them into the end of the year. But that's kind of how I'm seeing it. And I am seeing dollar strength, gold weakness, and a kind of higher rates in the shorter end of treasuries and lower rates in the longer end, which is a kind of flattening of the yield curve from where it's at right now. All right. Well, back at it next week. And if there is something that you'd like me to cover in particular, leave some notes here and post some comments on YouTube, and we'll cover them next week. So thanks everybody for tuning in, and I'll see you again next week.